We are carrying a total COVID provisions of 149 crores, which is about 1% of the AUM, and we are confident that we are adequately provided. This confidence is due to the portfolio resilience despite COVID headwinds. Our net stage 3 assets in Q3 at 4.5% is similar to Q3FY20. As per the Honorable Supreme Court's order, if we were to give effect, then the net NPAs would be down to 2.4%. This being the peak, we expect NPAs to decline in Q4 of FY21. We have received excellent support from our bankers during this entire period and a strong pipeline of sanctions in hand and expected. The current benign interest rate regime has also helped us bring down our Q3 cost of funds by 56 basis points over H2 of FY20, and we expect this trend to continue. We have achieved significant reduction in OPEX to the tune of 116 crores YY on a YTD basis, and this translates into a drop in the OPEX by about 70 bps during 9 months YY. Out of this 70 bps, we expect sustainable savings to the tune of 40 bps, while the balance will gradually come back as business picks up and the variable costs go up. As a result of above initiatives, despite additional COVID provisions made, our profit after tax is about 13 crores in the quarter from 22 crores in the same quarter last year and higher by 42% from 63 crores on a YTD basis 9 months to about 89 crores in 9 months FY21. With the COVID-related portfolio issues behind us, we will now focus on growing the disbursements from Q4. I will now give you the brief update on the strategic initiatives taken by the company. On the first initiative related to our sharpened focus on the high ROE products in ABF business, which is the used assets and tractors, its share is expected to increase from around 58% currently to about 80-85% by March 22. Around 210 crores of capital is expected to get released from non-focused portfolio runoff in FY21, which shall get deployed towards the growth of focused products. The resultant mix change shall provide a kicker to ROA and the ROE. On the second initiative, Magma Housing Finance, the wholly owned subsidiary, continues to carve out a niche for itself in the specialized affordable housing space. The capital raise process is underway and has so far received healthy preliminary interest from potential investors. Magma Housing hopes to receive firm investor interest over the next 2 to 3 months. On the third initiative, Magma HDI is well poised for growth and tap strong market opportunity in the under-penetrated general insurance space. On the capital raise front, we have received firm interest from few parties and we hope to reach definitive alignment in the foreseeable future. I now hand over to Deepak to share the update on the ABF business.
Thank you, Sanjay, and good morning, everyone. Giving a brief overview of the sector that we operate in. In the vehicle finance segment, hygiene factor and value buying have driven up sales in Q3 by about 10 to 15% YOY in the used car. This has largely been driven by entry-level segment and higher. Higher BS6 pricing and vehicle availability now good conditions are also driving used CV sales back to the pre-COVID levels. After a significant growth in the tractor sales in Q2 and for some part of Q3, there was a sharp decline in growth in December, about 25% and month-on-month basis. On our disbursements, our strategy to build focused product disbursements has led to the focused product book increase to 58% of the ABF business and will rise to over 60% by Q4. Used car disbursements are at 85% of the COVID levels and expected to normalize. Our used CV disbursements in Q4 and we will see a large contribution happen in Q4 from these product categories. The new tractor disbursements have been slow, but we expect normalization in the next one or two quarters. On the risk management front, the flows from the greater than 3 months moratorium was the key for us in Q3. As a result of a differentiated collection strategy undertaken by the team, we were able to manage these customers well, and more than 75% of these customers have paid us at least 2 EMIs or more in Q3 itself. Disbursals in Q4 will accelerate with us opening up all our product lines in line with the pre-COVID level policies and in our chosen geographies. With this, in this respect, our continued drive towards digitization of our processes as well as expansion in the channel network and engagement with channels should hold us in good stead. That's about it from the ABF front. I will now hand over to Manish for the housing finance piece.
Good morning, everyone. Magma Housing Finance now is a national scale affordable housing finance company focused on retail assets with minimal construction risk. Over the last quarter, the economic revival has been sharper in Tier 2 to Tier 3 towns. Our disbursement for the quarter grew 38% over the previous quarter, and we now stood at 367 crore, almost back to normalcy post the COVID-19 disruption. Our AUM has grown by 16% to reach 3,709 crore. The mortgage vertical AUM overall stood at 4,248 crore at the end of the last quarter. Our bucket zero collection efficiency has reached back to the long-term average of 98%, and collections have returned back to normalcy. Our gross three stage assets stood at 1.9% down from 2.1% during same period last year. The company showed prudence and chose to write off COVID-impacted assets of 24 crore during the quarter. Despite write-offs, the company reported ROA of 1.1% and the PAT stood at 10.2 crore for the Q3FY21. Our sourcing reflects our mission of keeping customer first. Over the last quarter, 60% of our fresh onboarded home loan customers are eligible for PMAY benefits. 74% of the loans sourced were sourced directly. Deploying technology and stringent control resulted in OPEX ratio reducing to 2.9% as a percentage of AUM by the end of last quarter. To encourage employees, there have been continuous engagement programs of senior leadership team through regular connect sessions, digital sessions, and the company now will currently focus on building a strong national franchise to serve customers with meager documentation in semi-urban and rural geographies. I'll now give an update on the SME business. The company focused on asset quality over fresh disbursements. Collection efficiency, even for SME business, has now reached back to pre-COVID levels. MSMEs are undergoing revival month-on-month basis, and their monthly sales are yet to come back to pre-COVID levels. Our SME team provided ECLGS loans to 3,200 customers with minimal paperwork. With pickup of economy, we are now cautiously optimistic to scale up SME business in the Q4. The SME business has also successfully concluded its pilot of secured lending in 3 states and now expects to double its distribution in this quarter. The SME business has also embarked on going direct and engendered transformation during these pandemic times to build long-term direct client relationships. Given the strong need for MSMEs to reboot and relook at their business model, our company also partnered with Wadhwani Foundation, a leading philanthropic institution, to provide them pro bono advisory under the Sahayata program. The MSMEs are reaping its benefit under various facets of programs such as advisory on digital learning management, resource management, and revenue enhancement programs through 130 hours of engagement thus far. I would now hand over back to Sanjay for update on general insurance business. Thank you.
Thanks, Manish. So Rajiv, our CEO for the insurance business, is tied up today, so he couldn't join. So I'll provide the update on the general insurance business. The industry has registered a growth of 4.9% in Q3, with all segments registering a growth except crop insurance. The motor segment also bounced back after 2 quarters of negative growth and registered 7.6% growth in Q3. The commercial segment grew by 17% and the health and the accident segment by 8.4%. On the overall basis, the industry registered muted growth of 2.5% during the 9-month period ended December 20. As a company, we grew by 2.3% in the third quarter with a strong growth of 82% in the commercial segment and 32% in the health and the accident segment. The degrowth in the motor segment also tapered from 6.6% in second quarter to 4.3% in third quarter. Traction in the health business continued this quarter as well. The health and the accident segment contribute to 6.3% of the total portfolio as on December. The activation of the dealerships, IT integration with newly acquired OEM partners and acquisition of agents continue. Our motor OD claim assessment through the video streaming is stable at 45%. Our investment AUM now stands at about 2,881 crores in December with a leverage of 6.6 times to the capital. By the way, our AUM in January has crossed 3,000 crores. Our profit after tax for 9-month period stands at 22.3 crores as against 7.3 crores during the same period. Our solvency margin as of December 20 is 1.81 times. With the distribution engine geared up, the claims in the operations platform stabilized. The company is well poised for growth. To conclude with the recent budget announcement of a proposed increase in FDI limit from 49 to 74%, we remain excited on the opportunity in the sector and the outlook for the company. So with that, I hand over back to the moderator, and now me, Deepak, Manish and Kailash would be happy to take on any questions that you all may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The first question is from the line of Sumit Palotia from MK Ventures. Please go ahead.
Hi, sir. Congratulations for the good set of numbers.
Thank you.
Yeah. Sir, I wanted to more understanding on the asset quality movement. So, you think that the GNPAs, pro forma GNPAs, that they have peaked in this quarter and will be coming down from next quarter onwards. So we've seen in the industry that the trend has been pretty divergent if I look at the peers' movement, purely vehicle finance companies. So, can you give us more color on, say, how the stage 2 asset, what kind of provision in this quarter specific to stage 3 assets, and have we dipped into the COVID buffer that we had? I think our buffer has also come down from 240 to 150. So, in restructuring, so overall stress assessments have put in our restructuring, and also the guidance have also increased a bit. Last quarter we had mentioned around something around 3%. And in this quarter presentation, we have mentioned it to be around 4.5 to 5%. So if you can just give guidance on all these three parameters, that will be helpful.
Yeah, one, I think your voice was quite muffled, but I understand your question is broadly pertaining to the asset quality, the write-off, the adequacy of the COVID provision, the outlook on the stage 3. So I think it's quite a all-encompassing question on the portfolio behavior, and that is what I will attempt to address. So the reason we have said that the Q3 is the peaking of the NPAs, which is the stage 3, is that this was the first quarter after the moratorium that 4 months have gone: September, October, November, and December. So therefore, the customers who didn't pay after the moratorium got over, and which is what in our previous quarter call we had defined, if you remember, as on September it was 1,500 to 1,600 crore portfolio, and as at October end, because we had a call in November, so we shared the number was about 600 crore. Now that number, if you look at slide number 17, the third bullet, we are saying this number is now down to 280 crores. So therefore, after the end of the moratorium in August, out of 15,000 crore portfolio, now 280 crore worth of customers, portfolio worth of customers are the ones who haven't paid the EMI from September till December. And all this portfolio has already moved into 90 plus. So they have already become stage 3. And that is exactly what we had given a guidance that Q3 will be the peaking of the NPAs. And that is what has happened when our NPAs, if you look at in the same slide 17, stage 3 has moved up from 710 crores to 927 crore. Now, how do we say that it has peaked and now it is stable? If you look at in the March, our stage 3 was 914 crores, which was after taking the benefit of the moratorium in the month of March. And that number is now 927 crore. After, the entire portfolio has moved up, who took the moratorium. And therefore, we believe that now it can only come down and it cannot go up. This is the second reason. The third reason is in the same slide, the first bullet, we have explained the collection efficiency month on month. The first month after moratorium, it was 84.5%, which went up to 19 October, remained at 19 November, improved to 94 in December, and further to 97.2 in January. So there is a consistent improvement in the collection efficiency, and that gives comfort and confidence to us that now the NPAs will come down and the collection efficiency will keep improving. And now if we go to the next slide, which talks about the restructured portfolio, which is on slide 18, the total restructuring done by us is about 1.9%, which is 281 crores. The important thing here is that while we have restructured the portfolio of 281 crores, and if you look at the left side of the table, it shows that stage 1 is 34, stage 2 is 235, and stage 3 is 12. But we have not altered the staging after restructuring. So while we have given the benefit to the customer of restructuring, we have not recorded the restructured lower bucket in our books. And therefore, if you look at the right side of the slide 18, you will see that stage 1 is only 2 crores out of 281. Stage 2 is 262 crores and stage 3 17 crores. So this is based on the pre-restructured portfolio plus the payments made by the customer during the structuring period. And that's how we have recorded and reported the numbers. Whereas the middle bucket in the table, 256 crores is the stage 1. That actually is if we take the benefit of the restructuring, which we have not taken. And the third point and the last point here is that when we have restructured the portfolio, we have retained the original provision. And also, if those customers who have not paid after restructuring and have moved up in the stage 1 or stage 2, there we have made an additional provision of 10%. So, in nutshell, out of 281 crore portfolio, we have restructured portfolio, we have made a provision of 43 crores, which is about 15%. So, sum total of all this gives us the confidence that we are adequately provided and we still continue 150 crores worth of provision as against 117 crores in March 20. And we believe that we will not need to consume this in Q4 entirely, and we will carry over a significant part of this provision in FY22. I think I've tried to answer different parts.
Yeah.
Something is left in an answer.
Yes, sir. So very helpful. On the restructuring, what kind of restructuring are we doing? Tenure restructuring, extension, or what is the exact nature of restructuring?
Maybe our CFO Kailash can give a specific response to this question. Kailash, over to you.
Yeah. So when we do restructuring, we do not give any rebate on our rate of interest. We do not give any top-up loan. We only increase the tenor of the loan.
Okay. And what kind of extension on tenure?
It depends. If it is, it cannot be more than 2 years. Generally, that's the RBI guideline. So we stay within the guidelines.
Okay. Thanks. So one last question on the provisioning. Any target provisioning coverage that we have in mind?
So you see, our overall coverage of the ECL has improved to 5.3% in December, as against 4.8% in September, and as against 4.4% in March. And so far as the stage 3 is concerned, it is stable at 36.8%, as against 38 in September and 36.5 in March. So the stage 3 PCR, provisioning coverage ratio, is guided by the LGD experience that we have, which is the loss given default. And what we have seen in Q3, and there is another slide if I take you to, which is the total waterfall of 182 crore of NCL that we have debited to the P&L in the year. If you look at the third line, which is the loss on settlement or repo, it is back to the pre-COVID levels at 50 crores, and if you see in Q3 of last year also, it was 58 crores. So what we are saying that repossession, sale and settlement is now almost same at the pre-COVID levels, and also we have seen that loss on sale or the loss on settlement in terms of percentage also compares same with the pre-COVID levels. And therefore the LGD rates are guided by that, and we believe that they have not deteriorated.
And to just give another point, Magma writes off entire ABF portfolio if it moves to 730 bucket, and SME portfolio at 400 if it moves to 450 bucket. So to that extent, you will never see that the portfolio stays with us if it is in higher bucket. It is written off. This is not an India's requirement. This is Magma specific policy.
Okay. Thanks a lot.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Vibha Batra from Fair Connect. Please go ahead.
Yeah, thanks for taking my question. My question is on emergency credit line disbursements. If you can tell me that what percentage of disbursements in current year are under emergency credit line?
So, Kailash, would you take the question?
Sure. So our total disbursement under emergency credit line is 325 crore. This comprises of 110 crore in SME loan book and balance 225 crore rupees in the ABF loan book.
Okay. This is for the 9 months current year or only for the quarter?
This is to date, the entire ECLGS.
Yeah, till date. Okay.
Yeah.
Okay. And this loss on repo in relation to the asset value when you repossess, what would be that percentage now?
Deepak, would you like to take that?
That would be in the range of about 38 to 40% right now.
38 to 40%. And it was similar in Q3 2020 also?
Yeah, that's what we mentioned, right? We are back to normalization. We haven't seen any deterioration in the loss rates on the repo and repo cases.
Okay. Actually, loss in repo in absolute value, it has gone up sequentially if you see. But I think that's because you have done more of repo sale and Q2 was. Okay. Would it be possible to give the movement of NPAs and restructured assets? Like Mr. Chamaria very nicely explained how, what is vulnerable, because there are overlaps now in a lot of cases, stage 2 and restructured. So if you can pick the vulnerable assets and how they are moving quarter on quarter, it will be really helpful.
I think what you have to look at is our slide which shows what is the amount of stage 2 and what is the amount of stage 3. You would see that the stage 2 and stage 3, this is slide 17, 31st March, stage 2 was 1366 crore, 31st December 1582 crore, stage 3 916, it stands at 927 crore. So we are more or less in a range at the pre-COVID level, which is 31st March 20. The second question is on OTR. We have clearly said, and Mr. Chambia mentioned it, that the entire OTR stands or we do not take any advantage. So while the slide 18, so whatever is covered in stage 2 and stage 3 already covers entire stress. There is nothing which is there in the zero bucket or stage 1. Our conservative policy ensures that we do not take any advantage of the OTR and show bulged bucket at the zero bucket or 1 bucket. The entire pain has already moved to stage 2 and stage 3. So you do not need to actually focus on OTR separately. It is already part of our stage 2, stage 3.
Actually, what I'm trying to say is that there is an overlap between restructured and overdue accounts. So, one should not double count. So if you just take a pool of vulnerable assets and then share the movement.
Excuse me, Viva, I will explain you. I understand your question. Typically, what I've seen in quite a few reports, if the NPA in a particular organization is 7% and if the restructured assets are 3%, then analysts take it that 7 plus 3, 10% is the portfolio.
Precisely.
That's what I understand your question.
Yes. In your case, it is 7. It's closer to 7. So if you take that pool and show the movement coming quarters, it will really, be evident. Yeah.
So therefore, just to put the simple answer, in our case, while we have 1.9% of the portfolio which is restructured, but as Kailash mentioned, and before that, as I drew the attention to slide number 18, we have not reinstated the bucketing post-restructuring. So they stay pre-restructuring. And because they stay pre-restructuring, so therefore whatever is in NPA has been reported in NPA, whatever is in stage 2 has been reported in stage 2. And therefore, in our case, 6.9% GNPA and 4.5% NNPA already includes your impact of restructured portfolio. That is what I would say.
Yes, sir. Yeah, I think this is a good table and you explained it very well. I was trying to understand this. Yeah, thank you very much and all the best.
I don't know if Manish, Deepak, they want to add something onto this or...
I think Sanjay has wonderfully explained. I have nothing more to add. This is a brilliant explanation. And Vibha, that was a great question.
Good. Thank you.
Okay. All the best.
Thank you. The next question is the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. So just I wanted to understand, you are talking about flat AUM in FY21. So that effectively means 7.5% kind of a quarter-on-quarter growth in the fourth quarter, which seems quite steep to me. So any comment on that would be helpful, and any growth outlook for the next year. Yeah, thank you.
So I think there is some misunderstanding. What I said that a leading rating agency has predicted a modest growth of 6 to 6.5% for the vehicle finance portfolio at an industry level in FY22. But so far as Q4 is concerned, what we have guided is that we will improve our disbursements now that portfolio quality related issues we have put behind. We are very confident about it. And our endeavor is now to arrest, and this is what the guidance we gave even in the last quarter, that the portfolio may decline AUM till Q3, and in Q4 onwards it will stabilize, and that is what we would endeavor to achieve in Q4. That means our 15,000 crore overall AUM will not decline in Q4, and next year obviously we will look to grow at least 10 to 15%.
Understood. And in terms of your credit cost also, since you mentioned that from fourth quarter you are expecting like this third quarter the NPA has peaked out. So by when you are expecting your credit cost to also normalize, and what would be the new normal of the credit cost, like post COVID? So where do you see your new normal in terms of credit cost?
So last year our credit cost was at about 3%. This year for 9 months, annualized is 3.5. We expect this to be in the range of about 3.3 for the year as we end March, because fourth quarter we expect better performance, reduction in the NPA, reduction in the NCLs. And the new normal, because we have now stopped doing the non-focused business of new car and the new CV, and our share of the mortgage is increasing, and the tractor and the used assets. So therefore, the new normal of the NCL should be between 2.5 to 2.75%.
Okay, so 2.5 to 2.75%. So that's what we can start from first quarter, right? That's what we can expect. Like the normalization of your credit cost may start from first quarter of next year.
No, I don't think we will be able to comment on that right now. Right now, I think that guidance we will give in the next quarter call once we end the year and we have done our workings. But I understood your question as to what is the new normal post-COVID. Then I would say new normal post-COVID based on the portfolio composition should be between 2.5 to 2.75.
Understood. I think that's it from my side. All the way best. Thank you.
Thank you.
Thank you. We would request the participants to please press star and 1 to ask a question. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hello, sir. Good morning, and thank you for giving me the opportunity. So my question is with regards to our housing finance business. There, what is the normalized leverage level that we are comfortable with? I suppose currently it is close to 4.5 to 5x. So what is the leverage level that we are comfortable with in that segment?
So, Kailash, I'll take this question.
Yeah, please go ahead.
So, I think we believe that 4 is a good leverage level to have, and as Sanjay has already given in his strategic missive that affordable housing business is in the process of capital raise. So we are very conscious of what we are doing, and I think these 2 would tie up your answer.
Sure, sir. Thank you. And the second question for the same segment. So I understand that we are in the smaller ticket size between 9 to 13, below 15 lakh ticket size. But we have seen that even in this segment, the competition is increasing. So are we seeing any pricing competition playing out there? And what would be the normalized ROE profile that we are looking at this business?
Okay, there are quite a few questions all put together. Let me slice each one of them. So, in terms of pricing pressure, while it may look like that there are a plethora of affordable housing finance companies, but if you really see, the markets are very localized. In terms of distinctive national character, there are far and few players. So in terms of localized competition, the intensity by and large remains same. We have not seen any abnormal trend or pricing pressure. That's to answer your first question. Then looking at the normal ROA and ROE, you can do your math. This is leverage, but our sense is that this business on a steady state basis should eventually reach towards an ROA moving up, graduating from 2.5 to 3%.
Okay. So, sir, since you said that the competition is broadly localized, so are we seeing a vacuum created because the smaller NBFCs, the smaller AUM or smaller NBFCs are still struggling, and therefore we are able to gain that market share there?
Well, I can say that that there is no letting up on the demand, and irrespective also, though far and few players or one or two players not really active, has that changed the market dimension? I feel that the size of the opportunity and also our landscape, I think it's basis our installed capacity. We feel that there is comfort. There is not such a mayhem or a shakeout that you've seen a large vacuous space being created. To answer your question, it's probably very mild impact, and it is yet not played out.
Okay. Thank you, sir. That is from my side. Good luck for the next quarter.
Thank you.
Thank you. We would request the participants to please press star and 1 to ask a question. The next question is from the line of Abhishek Murarka from IIFL Capital. Please go ahead.
Yeah, hi, good morning, sir, and congratulations for the quarter and the kind of provisions you have made and the great explanation you gave, earlier in the call. So just, moving on to the insurance business. So your tie-ups, you've mentioned that you've tied up with the leading NBFC. So if you can just talk a little bit more about this tie-up, what products, And the other question on insurance is in terms of combined ratio now, on an incremental basis, you are running at 117%. What, whereas 9 months is still 120, so clearly you're improving that. What is the target for 22? Where do you think by end of 22 you should get, or what are you planning for?
Abhishek, it is paradoxical that this is the first time in many quarters that there is a question on insurance and our CEO Rajiv is not on the line. But anyway, I will attempt to answer the question to the best that I can. First is that we have got a very proud set of tie-ups with the largest OEMs in the country, be it in the passenger vehicle, commercial vehicle, tractors, two-wheelers, and among the specific set of companies, whether it is microfinance, gold loan, etc., and even in the vehicle financing. So today, for a company our size, the tie-ups that we have, we can actually do much higher amount of business, and that is the reason we were looking to raise a growth capital. And as I mentioned in our strategic initiative, that we are now pretty close to achieving closer on the same. And in terms of the combined ratio, we are now on a declining trend. And while we are at about 116-117%, after giving impact for some of the motor OD loss resale that we did and the TP loss resale that we did, reinsurance, on a normalized basis, already we are down to about 113% in terms of the combined ratio. Our endeavor is that in the next 3 to 4 years' time, we would like to take the combined ratio down to about 103 to 104%. And in terms of the growth that we are witnessing, it is coming largely now from the health, because the board has mandated the management team that we would like to see if we can grow the health business from a low single digit to a double digit. So already we have crossed 6%. We are at about 6.3 or 6.5% now. And I think soon, maybe in the coming couple of years, it should touch about 10%. And here also the tie-ups with the lenders on selling the bundled product on the health insurance also is helping grow the volumes. I don't know if I've answered all your questions on insurance.
No, sure, sir. Thanks for that. And one question on the ABF business. Now, this repo activity, typically when you repossess and the vehicles come to you, you would be you would be seeing some settlement by customers, and then you proceed to sell those vehicles. So this rate of settlement after repossession, has that improved?
Yeah, I'll take that. Thanks. It's a great question, and it's one of the most important parameters that we measure in the ABF business, because our endeavor is not to really repossess everything and resell. The objective is for the customer to actually come back, make his payments, and release the vehicles.
Right.
In the last quarter, we have seen a significant improvement in terms of the release percentages going up. We stand at about 65% on the release percentage side, which is a very, very heartening sign, which means that there is cash flows returning to the customer, and customers seem to be wanting back to deploying their assets. So that is where we stand at. Q4, we expect an even better performance in terms of the release of the assets after repossession, and that is the sign of the economy coming back to normal for us.
Historically, sir, what is the highest release percentage that you have reached, and what is an average? Just a ballpark.
Yeah, so ballpark, we look at about 75% release is what we want to maintain it at, and we are already at about 65% now.
And the highest would have been what? Like just highest ever or highest in last 5-7 years?
So that 75% is a number that we would have moved along with most of the times.
Okay, because it's so cyclical. So at the peak of the cycle, it'll probably be 75, but at the trough, it would probably be, 40s or 50s. So that's why I was looking for an average also.
So even during the trough for us, we have never hit a 40 kind of a number. It was only during the beginning of the quarter where we saw that kind of a number happen. But like I said, it quickly came back to a 65 as we entered the quarter, and in January also we've seen improvements. So we are happy with the way it has progressed on that front. But we were worried when it was about 45 in the beginning.
And in terms of number of vehicles being repossessed, that has also come back to pre-COVID levels, or there you are still going slow?
No. We are at pre-COVID levels now. We were obviously not doing as much because of the economic situation, and we were not really wanting to put additional stress on the customers. But as we ended December and in January, we are at the pre-COVID levels now.
Great. And the final question, sorry for multiple questions, but just one more question on the ECLGS portfolio. While you have given disbursements, do you see any kind of further stress in that pool, or customers where you think that you might need to either restructure? Well, you can't. You may need to restructure, or it may slip into NPA in the pool. And any reasons that you can catch, why there would be additional stress?
So is this question specific to the ABF business, or are you asking on an overall basis?
No, both. So ABF and the SME portfolio also. I'm just trying to see whether there is further stress in the ECLGS pool, because one of the banks have actually said that they've had to restructure further into the ECLGS pool also. I'm just trying to see what kind of stress or lack of stress you are seeing in that portfolio.
Can I take that question, Deepak?
Go ahead.
Yeah. So we started, ECLGS from the first quarter of the current year. And first quarter and second quarter, we have done roughly about 60% of the 325 crore which we are talking of. And the balance has happened in the current quarter. We do not see any significant stress in the first quarter or in the second quarter. And when we had this discussion, our board looked at especially the entire ECLGS portfolio, parent portfolio, how it is behaving. We did not see any significant stress in that portfolio. And therefore, we would believe that our selection of ECLGS customers has been prudent. We have not gone overboard. And of course, we are definitely not managing our portfolio through this ECLGS scheme. That's a categoric assertion from our side. This will not give any surprise. This is just business in usual, and our duty in the current difficult times to support wherever we could to the good customers who had potential to do good business but needed money, and government came out with a scheme, and we supported our customers.
I will just add to what Kailash has mentioned on ECLGS that for SME business specifically, it was also an opportunity to look at customers who were good quality borrowers, but unfortunately they could not get supported by their bankers or their other NBFCs. So in a way, it was cherry picking of good portfolio from the market as well as our own customers. Our philosophy was not to put good money after bad. So I think we have stayed very conscious. On slide 15, you can examine the numbers. The portfolio behavior, though early, is giving such indications.
I think the way the ECLGS was also implemented for ABF business is very important to understand. We did not just disburse the money because the customer was eligible. Each and every customer that the money was disbursed to underwent a due diligence on the credit side on two parameters. One was in terms of ensuring that the asset was still with the customer and in good condition, and second was a line of sight of his cash flows returning to the normalcy. So these two key parameters were looked at before any disbursal was made on the ECLGS front.
Sure. Thanks so much, everybody, and all the best for the future. Good to see great numbers here. Thank you.
Thank you.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. So on off-balance sheet, across the industry, we were seeing that there was some demand for the portfolio, and there is a higher amount of off-balance sheet or assignments which was happening. So how do we look at maybe in terms of ARM, if it's still remaining broadly stable? So across the businesses, if you can highlight maybe if there are opportunities and off-balance sheet could be the other way of maybe the borrowing source which we could want to tap given the demand which is there in the industry. So what would be your maybe your call on that?
So Kunal, I think sometime back we shared that our policy with regard to the PTC or the DA will be more from a treasury standpoint than anything else. And given the surplus liquidity which we have had in the last 3 quarters and consistently over 2,500 crores, there has not been a need felt for doing the PTC or a DA. So marginal amounts we have done. In fact, to that extent, our this year overall volumes of DA is lesser than last year.
Okay. So I think it can continue. So the off-balance sheet proportion will very much stay more or less kind of a flat.
Yeah, I think it will remain in this range. It may go down or go up a little bit, but it will be either ways, but remain in a very narrow range.
Sure. And secondly, in terms of the collection efficiency, we have highlighted the overall increase which has been there from 84.5 to almost like 97.2 now. Now, if you can broadly suggest in terms of the product segment, any place wherein we are seeing much better than anticipated or much better than industry average collection efficiency, and somewhere we would be lagging. Apart from the SME, you definitely highlighted that it seems to be relatively more stressful. But besides that, within the product segments, if you can highlight how the collection efficiency is panning out.
So maybe I can give an overall view, and then Deepak and Manish can respectively, touch upon the respective product segments. See, in every product segment, you have a range of collection efficiency across the players in the industry. And it's not a reflection on whether somebody is better or worse, because it is a reflection on the customer segment that we cater and the type of asset that we cater. So, for example, if I take mortgage, we are catering in the affordable segment, and within affordable, we are catering to the self-employed segment. So, if one is catering to the salaried segment versus the self-employed segment, there would be a difference. So, one needs to compare apple to apple. So, if we compare our own performance to the past, there I think we are doing pretty well in SME or mortgage or even in the ABFs. Similarly, in ABF, for example, if you are doing to the fleet operator versus you are doing to the single truck owner or a single taxi owner, then the collection efficiency percentages would vary. And we are confident, we have reasons to believe that the customer segment and the product segment in which we are operating, we are pretty much at the peak rates at the top quartile or the top 10% in the industry in terms of the performance. Now I'll leave it to Manish and Deepak in case they would like to add something to this.
So on the ABF front, we've touched about 98.9% collection efficiency in January, which if you look at Jan 20 numbers would be roughly around 99 point something. So we are pretty much there on that front, and I think that is a better measure for us to look at rather than looking at peers, because like Sanjay mentioned, depending upon the product category and within the segments within those products as well, collection efficiencies should vary. So from that standpoint, the ABF business is extremely comfortable is what I see, and January has been the one month that we have seen the swing happen in the right direction for us.
And this would be including the arrears as well.
This would be including, sorry?
Arrears, maybe the past or dues as well.
Yes, of course.
Okay. Because maybe a few of these guys were reporting more than 100% okay, including the arrears, maybe 105, 110 as well. So maybe I think if we knock off arrears from this, then how purely it would be in terms of say the collection to billing?
See, again, this would be getting into too much of analysis because different organizations compute collection efficiency in different ways.
Yeah.
When you repurchase and sell or repurchase and settle, sometimes some people also include that into the collection efficiency, whereas some don't. So I think it all depends upon how you calculate, but as long as you maintain consistency in your own definition and then report the numbers that how it is moving month on month, I think that to me is the true measure of the trend, whether it is improving or deteriorating. So in our case, when we said that it was 84.5 in September, going up to 94 in December and 97.2 in January, it is on the same consistent definition.
Sure, sure. Thanks. This was helpful. And lastly, in terms of, say, the rundown and overall the disbursement, so still maybe when we look at it overall in terms of the rundown, given the improvement in the collection efficiency, finally we have seen some kind of a decline in the overall AUM. And in terms of the focused business, it is like 200 to 300 crores up. So now finally maybe should we expect that, okay, collection efficiency would also stabilize, and whatever incremental disbursements are happening quarter on quarter, that should ideally add on to the AUM growth next quarter onwards. So you said it should be more or less flat, but just trying to get into it, because I think now further improvement in collection efficiency, it should be more or less stable. So if there is any delta in disbursement, it should reflect in AUM growth, which has not happened in this quarter.
So our top priority, if I look at the waterfall, first was to have a normalized year in terms of the NPA and the NCL despite COVID. And now having completed 10 months in the year, we are confident that we will have a normal year ending in terms of GNPA and NPA and in terms of the NCL. The second priority was in terms of the strategic initiative, pivoting the business towards the higher yield and the higher NIMs. That also, like, it is now at 58%, which will increase to 85% by end of next year. And overall then our NIMs, which is currently at about 8.5%, 8%, will actually cross 10%. The third one was also the OPEX reduction, which has now gone down to 3.4. We have also given the guidance that it may increase by another 30 bps due to the variable expenses coming back as we return to normalcy. So with all of these things, now our priority in Q4 is to arrest the decline and maybe have a flat AUM compared to Q3, and then next year start growing, where we have given that we would like to grow at 10 to 15%. I think Manish wants to add something to this, so over to you. See, we are all digitally connected, and so I can see Manish wanting to say something. Over to you.
Sanjay, it's amazing. You're watching body language. Thank you. So I just wanted to only say that even if you look at this quarter's deck, all our focus products across the sector, we are either stable or growing. It is the defocused products which have contributed to decline in the last quarter. So in the net sum game, while it may appear a decline, but I think we are now relatively well focused, I must say, in a focused product category to record growth. And I think we already mentioned that in the housing business, we have seen a growth of 16%. In SME, there is a clear rebound, trajectory is on. And also, if you see these slides, also on ABF, the core focused products, there's a clear stabilization which is established. So at an entity level, I think we are quite reasonably comfortable where we are. And whatever is non-focused, that anyway is a strategy to run it down to be more capital efficient.
Sure. Yeah, this was helpful. Thanks a lot.
Thank you. The next question is from the line of Sachit Motwani from Param Capital. Please go ahead.
Yeah. Hi, sir. Congrats on a great set of numbers. I just had a question on your capital raise in the subsidiary. Can you indicate some timeline with respect to capital raise, both in housing and the general insurance subsidiary?
So, Sachin, as I mentioned, even in my initial comment that so far as insurance is concerned, we had started the process much earlier. During pandemic, it slowed down. And last quarter, we said we had received interest from quite a few bidders and we were evaluating. And now we have received the definitive interest. And I think we will have this closed out in the foreseeable near future. So far as housing is concerned, that process we launched from September. And given the affordable housing being the flavor of the season, we have a fair amount of interest being expressed. And I think in the next few months' time, we should be able to also go the same path as the insurance.
Okay. And you mentioned about 12 to 15% AUM growth, next year onwards is something that you're looking at. So this would be only for your focus products, or this would be on an overall AUM basis?
In fact, it will be slightly higher in the focus product because our defocused products will have a negative effect on the AUM as it will go down, and we are not adding, and which used to be about 40-45%. So therefore, we'll have to grow faster in the focus products than even 15%, such that on an overall basis, we will have between 10 to 15% growth in the next fiscal.
Okay, great, sir. Those are my questions. Thank you so much.
Thank you. Due to time constraints, that was the last question. I would now like to hand the conference over to the management for closing comments.
Yeah. So thanks a lot for very active participation by all of you. And it has been a pleasure for me, Kailash, Deepak, and Manish to try and answer all the good set of questions. And look forward to you in the next quarter. Thank you very much.
Thank you.
Thank you.
On behalf of ICICI Securities Limited, that concludes this conference.